Good morning, warriors. Good afternoon. Good evening if you're in Australia. Also want to welcome our viewers from investing.com. How's everyone doing today? I have Mark Newton, contributor on CNBC, great technician, scheduled for the top of the hour next hour. Stick around for Mark. Hi, Ziggy. Yeah, thank you. Pinky. That was my mom's nickname when she was out there working to raise a family. Bringing back some memories for me this morning. I do want to start with the yen because 11.5, 1160 was a sell zone, and I believe there must have been some action. Was it BOJ today? I'm sure that the team will fill us in, but we pushed up towards 1170, giving the short side a shot. I wasn't up in time, so I'm short from 60, risking the highs. We'll see how it plays out. Not a bad day. All my fibs make it look pretty busy. But I think the yen, if it's going to be bad and get this break back down under this 1078 level, should happen from here. All we can do, Blake says it all the time as traders, is control the risk. So shorting it up here, you know where you're wrong. Although I don't really recommend you put a stop exactly over swing highs or lows, because I'm sure everyone's experienced a stop hunt where they do that. People say, well, Dale, how do you know where the stops are? And I say, imagine you're short, where would you put yours? Imagine you're long, where would you put yours? That's where they all are. So don't put your stops where they all are. Give it a little more tolerance, maybe an extra 20, 30 pips, so that if it's just a shop for liquidity, you could still be alive. I mean, there's so many examples. I could go back to what crude did before it recovered, but we had that exact type of scenario here at the last high. It was right here where we just made a marginal new high and then sold off pretty good. So be careful of the stop hunts. Also, you know, very important piece of the business that I'd like to cover today is right here. So, you know, when we're driving, we have to navigate the roads, a lot of stoplights when you're not on the freeway. You know, I tell people don't run red lights. So you can see in the pound, there's really only one red light. It's either all go or neutral. And you know, when you have confluence in certain markets with Elliott wave, harmonics, basic technical, candlestick, and macro, the more confluence, the better. We don't dictate to any of our analysts certain position. We're all able to express what we see. And that's the beauty of it, that we're all using different methods. And when they all come together, pointing towards the same outcome, it's going to give you more conviction and confidence about a higher probability outcome in your favor. So I say don't run red lights, or at least short red lights. Aussie Kiwi has 3 of them right there. So it's really as easy as knowing, you know, what the colors of a stoplight is. A lot of neutrality in US dollar yen and the yen crosses. Euro pound, there you go. You have 3 red lights. I know that the short side has been successful for our subscribers, and Blake and a lot of other traders have been working the short side of Euro pound. So it's really, you know, you don't have to be a rocket scientist to interpret our analysis. In fact, to prove it to yourself, I recommend you just at least at the minimum take a trial for $1 for 10 days and learn to navigate it. We also give some direction in trading. So we call them patterns in play. As you can see, our macro guy, Stelios Kantos, really got short the NOK, USD NOK at the top, up 2% already. So he saw this as a great short. And the crude, although a lot of people were talking about a top in crude, myself included, USD NOK heading lower because of the recent push in oil prices, as well as he's one of the best fundamentalists I've ever met. I've been in the business for at least 16 month, 20 month, I mean 30 years. So after you've been in the business for 30 years, you can recognize talent, even if it's not you. And I believe that we have the best team on the net, that this Face webinar, people for free, we're edifying and building them up every day. But it's only the tip of the iceberg, because we have a members chat going all day long and into the night, 6 days a week, even on Sundays, getting prepped for the following week. So as you can see, maybe you don't think I'm objective, but I think it's the best, not just FX, because we cover other instruments, bonds, crypto, stock indexes, so European bourses, DAX, that you can find on the net. So I challenge you to take the trial and tell me I'm wrong. You know, you could email me and we'll talk about it. I'll even refund your $1. So that business being taken care of. Just a couple more things I want to talk about in the market. Gold got turned back. The precious metals got turned back in a very aggressive way. And in fact, right at this moving average, and I know there were people looking to do it at about 1310 to sell this rally. So this was about halfway back of this $65 decline. Broke above this channel line and then back under 1304. It looked pretty ugly. So I think as long as we stay under this 1308 level, there is potential for it to try the lows. If we have a quality from here, it's going to take you down to about the 1250 level, 1265 right in here. So right now, this sure looks like a bear flag to me. 65 down, consolidation, getting a bear flag measured move would take it down here. Silver, even uglier. It was acting better on the way up. So silver, if it doesn't hold 1511, we'll see how deep it goes. I thought this was going to hold this $15 level. It did for a 56-cent rally. And finally, with my short position in the yen, I'm looking for a continuation of lower rates, lower yields. And when you look at the 10-year yield, you have it trying to hold this base. We looked like we had a breakout, and the yen was making a lot of hay. It was railing pretty dramatically, but the bonds and the yields just couldn't get up here. When we broke out here, I thought we'd go 280, 290. Now we're on the verge of threatening low in yields at 254. I actually thought it might be a risk-off event, which wasn't the case, but to me it looks like we're going to take out this 254.5 and maybe head down towards 230-ish. Here we go, 236 on the weekly 200-week moving average. So this is a pretty big area. If bonds break down, I would think it would not just be the Fed, because the Fed doesn't control long-term rates. I almost think it's perhaps a sign that people believe global economic conditions are weakening, despite what global stock bourses are saying. And if we get a breakdown, I would assume that it might tie in with an eventual correction in the S&Ps. I never expected the S&Ps to do what they did this week. There was a Bradley low on Friday, but I wasn't looking for, this was Friday. No, this was Friday. Just a little hammer, and here we are. We've taken out the highs from the week before this correction. I would still be careful up here. As you can see on the daily, we're not confirming these new highs. I know some people are talking 28.45 or so for a potential high and then a correction, but to me it feels kind of late after this advance. So I've been trying to top pick it, thinking we'll get at least some type of reaction back down towards the 26.30. I still think that we'll get that before we see new highs in the market of 29.40. So as usual, time will tell. And I just want to wrap it with a bigger picture in the crude. The crude did make a new high. Paulie was here the other day when we were trading here, and I was trying to probe the short side for a turnaround Tuesday trade, and I got out, It pulled back to 640, but great call by Paulie. And that if you're in Europe or Asia, another big advantage for subscribing is Paul Franco, who gets up. He's in Texas, and he gets up at 1 in the morning to do what we call the European crossover, and that's midday in Europe. So you get kind of a heads up. He goes through a spreadsheet with all his major technical formations and price points to trade against. Paulie trades for a living, so it's not a hobby where he just looks at a chart and throws it out there for people to assume risk. He does assume risk every day. That's how he pays his mortgage. So there's just so much. I mean, the team was in New York. The team is on Real Vision TV. They're on Bloomberg. Really amazed at the kind of team that we have. I made well, it's not a joke. I said good morning to the best team in the cosmos. And I've been around long enough to know what is a good team, and fortunate to be part of it. So I want to thank Blake for, hiring me to host this webinar almost 2 years ago. I've never been at a place I've enjoyed working more and been surrounded by more gifted and humble people. So thanks, Blake. It's almost our anniversary.
Is it really? I'm glad you're keeping touch tabs, because I don't even know how many years that I've been married. I think we're on 16 or 18. I'm not really too sure. So
I like a prisoner, I X off the days on the calendar. But
that's great. I'm glad you do. I like I said, my wife and I both, I think it was last year, we're like, hey, happy 16. And somebody was like, you guys have been married longer than that. I'm like, wow. Have we really?
I know.
Like,
time flies.
Yeah, we are like celebrating wrong anniversaries. At least we got the date right, but I can't. I'm not even good with dates unless it's in my calendar.
And great call on the action in cable, Blake, this week. From Monday, you were talking about the triangle that we had, and it's been in there. I think it threatened an upside breakout of that triangle yesterday, didn't it?
It did. And actually, it did it in Asian trade, and it did it when I was taking a nap. So for you guys that don't know, I get up at 3 in the morning. So that's just, it may be 5 o'clock in the morning here right now, but I do get up early, and Dale knows this. He does it every single day, but I have to take a nap. If I don't take a nap, I can't make it through the evening. And I have kids and a family, and so I have to take a nap. And so when I was napping, the pound, obviously it squeezed higher. And what I did is I picked up some cable on the dip in Asia, basically. And I bought some at like 133. I want to say I bought some at 133.20, like right here. I bought a little bit more at like 133.80. And then it came up a little bit, and I said, you know what am I doing? I just took a little bit of a loss, and I said, I'm not going to sleep with this damn thing on. And but I wasn't sure what had caused the spike other than a squeeze, and that's all it was, is a squeeze. Now what we've got, and let's keep in mind that obviously there's for Theresa May, and Stelios is probably going to come in and chime in regarding this, which I don't mind. She's looking for an extension to June 30th. Wait, hold on. June.
Yeah, what? Like 2 months, roughly 2 months.
June, yeah, isn't it June 30th that she was looking for? June 30th.
Yeah.
And she's looking to extend, that long. So, what do you do with the cable here? I mean, technically it's like, okay, we had a little false breakout, so I don't want to be long. I don't necessarily want to be short, because if we get a good extension to June 30th, which, correct me if I'm wrong here, Stelios, feel free to step in at any moment. The EU doesn't want to extend that long.
The EU want to extend longer. Donald Tusk said today that he wouldn't mind, or he would be supportive of an extension of closer to something like 2 years. That's what they want. And it's kind of understandable because, you know, the deadlock that we are in right now, I don't think it's something that can be solved in a month or two. I mean, again, I'm not a politician, so I don't know what they're, you know, how they're going about solving this problem. But, you know, this is a big issue. You either leave as it is, or you try to solve it. And just trying to solve it, this, in my opinion, would take a long time. So the EU want a much longer term. The UK wants, well, Prime Minister May wants a shorter term. So what happens now?
Okay, so then if we get this extension, do you really want to be short the cable? Because I wouldn't, and I'm just stating. But you know, the flip side is there's a lot of politicians that think that Theresa May should step down now, and that is a risk to the cable. I was reading about polling about 63%. I think it's something like that. Want, and I don't know if that was the general public. I can't, you know, I read so much in the morning. It's like, okay, trying to make sure I have all my facts, especially Brexit being Brexit. It's so confusing as it is. But anyway, I think what could really hurt the cable is if, you know, obviously they don't vote for an extension, Theresa May steps down, and then you got a real problem. But right now it seems like the path of least resistance for the cable is higher. Does that mean that I want to buy the cable right now? Not necessarily. I mean, I do, but I don't. I mean, I'm not going to until I get an all clear today, at least. You know, I'll have to do some reactive type of trading versus what's the word I'm looking for?
Proactive, reactive.
Proactive, yeah, rather than some proactive type of, you know, trying to anticipate, because it's such a messy situation. So what we will do today, like we did yesterday, we're going to do the bias chart. We're going to set up the bias chart because that you know, I got a lot of comments about how people really enjoyed the bias chart from yesterday. If you guys were here yesterday, I'll set all those you know, levels up for you again today as we navigate through the markets, because I think, you know, just looking at the cable, like this is a good example. I think we have a better opportunity to be on the long side down here at 30.50 than being long up here at 32.20 or 32.30. So I'd rather be on the long side on a dip rather than trying to buy it up here up against this resistance. Now, you know, obviously we have resistance at 133.50. That's key. And yes, we did spike above there yesterday, but that was also in Asian trade. So don't read too far into that. So look, I'm going to write that down for right now. So if you look at, you know, if you're looking at the cable, right now the pound support is going to be at 130.50, and I know these are really wide parameters, but it's the pound and it's Brexit. So you know, trying to trade around these numbers, you know, and being, you know, kind of in the middle of the range is, you know, what you have to be careful with. And yesterday, we did it pretty well. I mean, you know, as far as what we were looking at, we had a rally up into the triangle resistance that we were looking at yesterday. We hit it and reversed. I have to go back and look at the bias chart from yesterday, but we reversed pretty aggressively from there. And then, you know, obviously in Asia, we broke through. So now I'm not looking at that so much, but I'm looking at where we're currently at and maybe an ascending wedge, which, by the way, just so you guys know, an ascending wedge is typically a bearish reversal pattern. So that means it typically will break lower. But you know, my other thought process regarding the cable is if we get a solid break above 133.50, I don't know if I'd really want to be short the pound either. So that's just, you know, some food for thought.
Like, if I may add just one comment, I agree with you regarding playing the pound on the long side, as long as there is an extension. This is a prerequisite. The other thing we have to remind ourselves is that, you know, we have a situation where Prime Minister May is kind of in a precarious position. Maybe she will resign, maybe not. The question is, if she does resign, is that positive or negative for the pound? I'm not sure it's negative. because, you know, the Conservatives, her ruling party, they're really split at the moment. And maybe the emergence of a new leader of the Conservatives, maybe it will bring everybody back together. You know, I'm hypothesizing here, but given how badly things are going for May, personally, I think that her stepping down might not be a negative development. You know, at least, well, maybe it's not. You know, I don't think it's going to be a huge positive development, but I don't think it's going to be the end of the world. It might actually help with the stability of the government, or in general, you know, of the political arena. Just a thought.
But
you know,
who would be that person? I mean, that's the next question, right? Who would be that person to unite United Kingdom?
Good question. Good question. There, you know, I don't know. Personally, I think, well, there are a few people, but I think, you know, people like Rees-Mogg, he's been talking a lot of sense, in my opinion, and, you know, there's been quite a bit of support for him. So, you know, I actually don't know, you know, who could come and take her place. But I'm just saying, if she does go, it's not necessarily the disaster that people are thinking it might be.
Yeah, and maybe that, you know, a big dip in the pound might provide an area for you know, longs to reestablish too. So, you know, and it's going to be tricky, and I'm not going to sugarcoat it. I think you have to be very careful. It's targeted trading in this environment, and that's just really what we've got to deal with. So, well, let's go through a couple of these majors, and thanks, Stelios, for your comments. Let's go through some of these majors ahead of you know, we have some, just a little bit of data coming out. We have like National House Price Index for Canada. We have like weekly employment claims, but it shouldn't be too big of a market mover, but we're gonna, you know, keep an eye on all that. All right, so if you look at the euro dollar, first and foremost, I guess we'll go to the 4-hour chart. We're struggling here at the 618 retracement. So, you know, one of the hallmarks here that I think we should note, minus it being the 618 retracement, is this little kind of false breakout above these highs and then reversal. So that is a little unnerving if I was long the euro, which I'm not. So I just, you know, saying if I was long the euro, I'd be a little nervous that the fact that we failed here at the 618. We made these little breaks above this resistance. You can see over here to the left, and then we're failing here. So now if I was long, I would be looking at this as being, okay, I don't want to be long if we get below, you know, 112. Let's just call it 112.70. So resistance, right, for today is going to be 113.40. And then remember, we also have downtrend line resistance that comes into play that is at 113.70, but I'll write them both down. 113.40, 113.70 is being, that's going to be key resistance. That's why I put an asterisk there. And then minor support today is 112.70. But like I said, if I was long the euro, a drop below 112.70 would indeed make me a little nervous about being on the long side. Now the cable is spiking up. The euro's following suit right now. See, the euro just spiked up. The cable just spiked up. There's all these amendments and referendums and just a bunch of crap happening right now that's spiking the market all over the place. All right, let's take a look at the Aussie. So, you know, the Aussie is very interesting. Now, if you missed the news this morning,
Blake, sorry to interrupt. This little spike was on the back of the Speaker of the House, who has refused an amendment by the ERG to rule out a second referendum. So the probability of a second referendum is slowly rising.
Wow,
that's why this happened.
Could you imagine having a second referendum? I mean, you know, I watched this video on what the people were thinking when they were voting for the referendum the first time around, and it was interesting just to see all the comments like, I don't even know what I'm voting for right now. You know, that wasn't clear, and yeah, I think, yeah. Anyway, what a disaster this has all been. All right, thanks, Stelios. And a second referendum would be hella positive for the cable. It really would. I mean, because I think you would have a lot of people saying, you know what, let's just stay in the EU.
Just one thought on cable, Blake, if I may add. If you pull up your 1 hour pound chart.
Yep.
Okay. All right, you see the spike that we had a few days ago on the 12th, and then we pulled back, and then we just made that high last night. That's one, and the spike last night is two. And earlier in the week, I thought we could go 134, 135 for three. So we almost got there at 34, but I'm looking for one more shot up. It'll probably take off that line. But, you know, if the dollar is going to hold, it's got to start digging in its heels above 96. So I'm thinking one more shot down in the dollar, one more shot up in cable for a three up there. Just a guess.
Yeah, and you know what? We're going to take a look at the dollar index, and that could be it. And a lot of the dollar index is being influenced by the cable right now. No doubt about it. No doubt about it.
Thank you, buddy. Just wanted to interject.
So let's go over to the Aussie. If you missed the news, Trump and Xi. Anyway, they're going to postpone China's Xi. Yeah, I'm Asian and I can't even pronounce it.
Anyway, you had it right.
Yeah, Xi. Anyway, they're going to postpone the meeting between Trump and Xi. So the Aussie came under pressure. Risk came off a little bit, and you can see the Aussie had this inverted head and shoulder pattern. You can, I have a squiggly line drawn. We actually completed it, almost hit the 50% retracement, and then we reversed. Now, you guys know, I'm hoping, and it's not going to happen anytime in the near future. I've been sitting here hoping that some China-U.S. trade deal would get done, and then I can short the hell out of the Aussie. I do think it's going to be bad for Australia. I think whatever deal that gets done is taking away from Australia, taking away from New Zealand, and it's going to benefit the U.S. and it's going to hurt China, or continue to be a drag on China growth, and which is just going to continue to hurt the Aussie. So I really want to short the Aussie, but the Aussie will probably get a spike up initially on some sort of China-U.S. trade deal and then roll over. And that's the way I'm looking to play it. Now, the problem is that I want to be able to catch it on a spike higher, and we're not getting that. But as of right now, 71 cents is the 50% retracement, and it's also resistance for the Aussie as we speak. So 71. Now, support in the Aussie is going to, well, you can see we're right back at the support zone. This is a big long-term support zone, and that all comes in right here at the spike lows today, which is 70.41. So I'll write down, we have 70, obviously. 7041 is or I'll just write 0. I kind of round it out a little bit, is support. I don't like specific numbers. I'm not a big fan of, right now. It's because support and resistance is all a zone. It's not a exact science. If it was, I'd be a gazillionaire if support and resistance was an exact science, but it's not. So resistance for the Kiwi is we build this triangle out. As you guys can see, it's a nice, pretty symmetrical triangle at this point. 68.85, 68.85, and support doesn't come all the way down till, well, I just will write down 67.45. So what do you do with the Kiwi? Nothing, not a damn thing. I mean, you can try to trade this, but trying to trade it in the middle of this triangle is dangerous. I would short here, buy here, and that's it. There's no, or you short a breakdown or a breakout. There's nothing else to really do with the Kiwi right now. If you guys are trying to trade around this Kiwi, you're probably frustrated as all get out because you're stuck in a consolidation. So because you're stuck in a consolidation, you're going to get whipped around a lot. Now, I should talk about the yen because I do have a small short in the dollar yen. It did spike up to the 161% extension of the last move down. Why it spiked up to above the resistance, no one knows. The guys in my office were all kind of floored on this move. Might have been the fixing on the CNY last night, but the dollar yen spiked above the 618. I think the 786, which comes in at 111.80, 111.87 is going to be resistance. So right around that number is the 78% retracement. support, as we look like we're breaking the bear flag yesterday, support now is going to be, you know, it's obviously at 111. I mean, as long as we're above 111, the risk of a downside move is not that great. And that's talking with somebody who's short. So 111 is obviously key. Now we have data coming out, not a huge amount of data, but we're going to watch nonetheless. Let's pull it over here. This is Bloomberg, just so you guys can see. There's import price index, a little bit hotter. Jobless claims about in line. You know, some revisions higher on some of the inflationary data. It's not moving the dollar at all. I mean, the dollar yen's come up a little bit.
It's nothing, I'm afraid. Yeah, another day of very little, actually, you know, significant data.
But you know, I remember, and I'll give you guys an example. I remember probably about 12, 13 years ago, I was dollar yen's coming up just a little bit. I was trading in the morning. I was in Texas working for the Wise Trade Group. I wasn't on TV that day. I was coming in the office a little bit late. I wanted to stick around for the data that was coming out at 7:30 a.m., which is 8:30 a.m. Eastern. But I was, you know, sitting there, and it was the Philly Fed index. And I remember the Philly Fed index just never moved the market. It never moved the market. But it was such an outsized number that day that we had like 180, 200 pip move in the euro that day, that morning, as soon as the data came out. And I was on the wrong side, so I closed my position, reversed. Dollar Canadian spiking up a little bit here. I am long dollar CAD, so I'll go into that here next. But and so that's why ever since then, and that was like 12 or 13 years ago, as I was just kind of, I still, you know, I look back, and even though I'd been trading the FX market for a few years, you know, bridging the gap from equities to currencies back then, you know, 13, 14 years ago, somewhere in that neighborhood, after that point, I always pay attention to the data, no matter as minor as the data is if it's an outsized gain or loss or hit a miss or you know, substantial number, it can really move the market. So I always really try to pay attention. Okay, the dollar CAD. So the dollar CAD, I do have a long. There is a you know, and I put in a pattern in play this morning. Right here, and you can see the 133.10 to 133.30. I was long. I put in one overnight, and then I decided I wanted to be able to sleep, and so I got up this morning, and we were right here a few hours ago at 133.10, and I'm like, you know what? I do want to be on the long side. This is as you guys know, the inverted head and shoulder pattern neckline retest. 50% retracement of this move. Also, it was just below the 38% retracement of that move, but it's a 50% retracement of the last move higher. So I wanted to be on the long side of the dollar Canadian. Now we do have some timelines coming up for the passage of the new USMCA as of tomorrow. So there's going to be some possible shots across the bow regarding you know, the USMCA and the new, you know, NAFTA agreement, if you will. So and I think the risks to the dollar Canadian might actually be to the upside. So what we have to start looking for, in my opinion, is, you know, this resistance comes in at 133.50 on the dollar CAD. I think that's going to be pretty important today. So 133.50 is going to be important, and then support for the dollar Canadian is going to be back down here. This is at the 132.90, and as long as we're above 132.90, I think the risk is for a bounce. Now, are we going to 136 today, which I think we're going to, because this is the inverted head and shoulder pattern target? You know, do I think we're going up here today? No, but I think we're, you know, this is a great risk reward for longs, because you're basically risking what, from current levels, maybe 50, 60 pips to make what, you know, 250. So that's, you know, a good risk reward. Now, it's not going to be a good risk reward if we're trading at 134.50, you know, because if you think about that from here, you know, and I'm grabbing my pen, we currently trade right here. Your risk is, you know, somewhere down here. Your reward is up here. But if we're up at this price, then your risk reward is only 50-50, and that's not a favorable risk reward. So if you're going to be on the long side, you want to be on the long side somewhere down here. I'm not saying you should run out and buy it right at this moment, but I'm just saying that if you are looking at the long side, you probably want to try to buy dips maybe back to 133, you know, 20 or 30 if you can, because I think that that's, you know, and on top of it, you know, crude oil just hit the 127% extension. I know there was some OPEC news coming out, but we're at 127% extension. If crude for some reason dips back below 57.50, that's gonna you know, help bolster the dollar Canadian. I don't know if that's necessarily going to happen. We got a little hangman here on the 4-hour chart. It's 24 minutes until this 4-hour chart completes, but a hanging man, let me see if I can pull up for you. So you know, for those of you that are not familiar with candlestick patterns, hanging man candlestick pattern. I'll just go over to Investopedia. You know, a candlestick pattern is a bearish reversal candlestick pattern that occurs after price advance. So, and it looks like, you know, like that, okay? That's a hanging man. And if we look at crude, we've had this really nice advance. If we stall up here, you know, a lot of people go, oh, wow, that's a hammer. Well, it's a bullish hammer if it's coming off of a downtrend. It's a bullish hammer. If it's coming off an uptrend and it looks like that, then it is a hanging man, which may signal a reversal in price. So taking that into account, if we do get a little bit of a reversal in crude, saying that, you know, if we come down like this, you know, like this in crude, if that happens, then that's just going to, again, it's going to boost up the US dollar Canadian. I think the US dollar Canadian is going to be a nice long. You'll benefit from a reversal in crude. But remember, the dollar Canadian needs to break this resistance. Let's go over to the peso. Now, if you guys watch Steve and Grega on Real Vision, which it's behind a paywall, but they did, I'm going to give you the gist of this trade without you paying. They're looking for a bearish move in the US dollar Mexican peso. Now, I will honestly tell you, if the US dollar Mexican peso, and I hate it when people say that, I'll honestly tell you, but I'll tell you, in my opinion, you have to be bearish the US dollar Mexican peso should we break this channel support, because this will be a flag. This will be a flag, and we'll break all sorts of trend line support, and, you know, we're going to go down in a blaze of glory, more than likely. Now, with that being said, I don't mind being long the dollar Mexican peso down here while we're above 1920, okay? And the reason is twofold. If we get some risk aversion, the dollar Mexican peso, well, pesos will probably be sold. Emerging market currencies will come under pressure. If crude oil can roll over, that'll also weaken the Mexican peso a little bit as well. I still believe that Mexico, or Banxico, is also about ready to start an easing cycle from their, you know, a little bit higher interest rate policy. They're going to start an easing cycle, which should allow for some weakness in the peso. I do believe Pemex is a big overhang over the Mexican economy, that the government is going to find themselves in pretty hot water if Pemex starts to see some trouble. So I think that overall the Mexican peso is a sell. But technically speaking, like I said, if we start breaking below this channel support at 1920, I'm wrong. I think technically. So you know, we could be that whole argument could be right over time, but in the meantime, the dollar Mexican peso could maybe drop to 18 before rallying. So now, as far as intraday goes, and let's talk more about what's relevant right now versus what what I'm just talking about, just as generally speaking. We're in a triangle consolidation, so I think a break above 1934 would be pretty bullish, because then you've got this move out of a triangle, and it might push us back into this longer term channel. I know Greg's wave counts weren't counting for that, but again, that's what makes a market, is you got a couple different viewpoints here. I'll look for a move above 1930. Well, 1934 would be bullish intraday, but really a move above 1937 is going to be really important, because then we're creating more higher highs versus lower highs. So 1937 will be resistance, and then support is going to be 1925, which is, by the way, this is a 618 retracement, just so you guys know. It's a 618. It's held us. You can see how we're making higher lows. So right now, 1925 is support. It's actually like 1925.50 is support, and that's going to be pretty key for today. Okay, where else? Where else I got to go? Dollar Swiss. Now, I played the dollar Swiss on the short side this week on this top side failure, and made some decent money, but I was a little skeptical as we dropped to 1.0050, and I've been out ever since. So I got out like right around here-ish, and so I haven't been dealing with it since then. But you'll notice there's a 50% retracement and a lot of support through here. Okay, you can actually take this all the way back and say, oh yeah, there is a lot of support back here, all these spike highs, and you can see it's a lot of congestion around here. So that means a break below 1.0025 should be bearish. Now, in the meantime, that is support. Resistance is going to be, any move back up towards 1.0070. Okay, but 1.0070. And you know what? I haven't been adjusting these ranges either. So let's see. Euro is in a range. Cable, I have to still put it's bullish in a range, but it's bullish. This is bearish. Sorry, this is a range. Swissy is, because of the topside failure, range. Dollar yen, it's a range. Dollar mex, it's actually in a range too. It sucks when everything's in a range. Believe me, I've been doing these bias charts for years and years and years. For about 15 years on the Wise Trade webinars, I did these bias charts every morning for free for you guys. And you guys that have been listening in to me for 8, 10, 12, 15 years, you guys all know that when everything goes range bound like this, it drives me bananas. But unfortunately, that's kind of the market we're dealing with right now, and we are dealing with a bit of a range environment. Okay, here's the dollar index. Now, Coach was talking about the dollar index a little bit ago, but the dollar, you guys know that obviously we have this big resistance up here. I talked about it on the week ahead video. It comes in at 97.70. Obviously we're not going to test that today. We're rejecting right now spike high resistance, breakout point support. Okay, came back down, support, broke through the support. Now we're using it as resistance again. So resistance intraday is 96.85, plain and simple. 96.85. It's upside, resistance right now. If we get above 96.85. That'll probably take us right back up to 97, 20, 30, 40, somewhere up there. Support 96.40. We probed the 618. We probed it, broke it, held it, but for now, that's going to have to act as support, because it break below 96.40, we're going to see 96 again. So 96.40 is support. It's not great support. That's why there's no asterisk there. It's not great resistance. That's why there's no asterisk there. It's just, we're playing the range. Let's do the Nordic currencies really quick. US dollar, Norwegian krona. Now Stelios, where are you at? Earth calling Stelios.
I am here.
Hello. Hey, so, you know, I want to say that great call on the US dollar, Norwegian krona. It looks like we're going to bounce. Now, yeah. I think the bounce, it should be capped right here at this level, right through here. I think this should cap the rally, which comes in, let's just call it 865. But you notice how we had this little breach of this trend line. We hit the 88% retracement, kind of give us a false breakdown, and you know, I'd be a little nervous if you were caught short at these lows. If you were gonna short it again, or if you were gonna add, or you were gonna, you know, look to, you know, play it to the short side, I think that, you know, maybe up here is a better place to do it.
I agree. We did talk about 857 yesterday, remember? And I took half my position off there, and it did go right a little bit lower, as the markets usually do, right? They just try and get some stops or get some people in the in a position at the wrong level and just bounce back. So yes, you're absolutely right.
So I'm going to mark it as a range, even though you're bearish. And the reason why I say that is because ultimately we're still, you know, we're making higher highs or higher lows, excuse me. Just the highs are now consistent. So that stops us from being a bullish trend. If it would have been a new high over here, then we'd been in a nice uptrend. But now we have to look at it more as a range at the moment because we have those, you know, matched highs, and then but we still have higher lows, which keeps us from being bearish outright. So for now,
great trade, by the way, still
very good stuff.
I get lucky sometimes, yeah.
So,
broken clock.
Here's the same deal with the Swedish krona. Notice how we spiked below this low, spiked below the trend line, and then right back up again. So support now is 927.50, 927.50, and I will say that the U.S. dollar Swedish krona, if you want to talk about a bullish U.S. dollar currency, this is different than the U.S. dollar Norwegian krona. Even though we have matched highs here, this is a really strong uptrend that we're in. Do I want to short the U.S. dollar Swedish krona? I think if the dollar looked like it was breaking down across the board, I would do it. But you know, right now, as I told you guys yesterday, got to be a little careful being on the short side of this one, at least for now.
I see two drives, Blake.
1, 2, maybe
one more.
But if we get one more, that's going to put us in a major bullish breakout. So then, you know, fading it to me would be like, no, thank you. That would be me. But you know, but I see what you're saying. Resistance for today. You know, I'm assuming resistance today is going to be somewhere up here. You know, you got this previous support. You got this, you know, the little spike high up here, spike high up there. So resistance, we'll start with 938 intraday. It's not great. 9.38. It's not great resistance, but I think it is resistance on the way up. So here's your bias chart, guys and gals. You know, this is your bias chart for today. We will go over other charts as well, but I hope that this bias chart helps you in, you know, devising a plan, a trading plan for the day, and that's what the intention is here. Remember that Paul Franco, he does this every morning on the European crossover webinar that is for ForexAnalytix subscribers only. Now, Paul and I aren't going to have the exact same numbers. However, Paul and I have worked together for many years, and I brought him on the Wise Trade team probably like 4 or 5 years ago, and then eventually brought him over here to ForexAnalytix. He is probably one of the better technicians you're ever going to meet in your lifetime. He trades the markets. He lives off the markets. I met him, and he was living purely off the markets. We pay him just a little bit. Not enough to live on. That's for damn sure.
Oh, you're Colonel Parker and he's Elvis.
He deserves more. I wish we could at ForexAnalytix pay more, but sometimes I feel like we're running some sort of nonprofit organization over here with the prices that we charge for the mobile app, the platform, all the ideas, the team, the chat room. It seems like a nonprofit organization, but anyway,
the trading for profit.
Hey, but it's for you guys and gals. So anyway, if you are a ForexAnalytix subscriber, make sure you listen to Paul's webinar. He does them every morning at 1 o'clock in the morning his time. So you want to talk about dedication, man? It's crazy. I'm sure he's sleeping. I remember one time we had a company meeting, and he was so tired because he was doing his late night webinars. We were having a meeting, and I have to, and just for Paulie's in Paulie's defense, it was a boring meeting. We were talking about something about like what kind of blog posts we're going to do, and all of a sudden we're like, hey, who's sleeping? Paulie's like, oh crap, I forgot to put mute. I fell asleep on my desk. Yeah. He'll never live that one down. Okay, guys and gals, let's go ahead and Coach, if anybody has any questions on things they want to cover, okay, I'm more than happy to cover. But before I do that, as you read through them, let me just talk about the S&P. The S&P, I had a short pattern in play, which was up like a nice %. Then it reversed because this market is bullish, and here we are challenging 2820. And fact of the matter is,
took the high out yesterday, Blake.
It did briefly, but the fact of the matter is, this market continues to climb a wall of worry. So is there still a risk of a move to 2840, 2880? Yes, there is. And you have to keep that in mind as you're trying to navigate through these markets. It's really hard to short the dollar yen when you got stocks continuously climbing higher. It's hard to play emerging market currencies short when you've got when you've got equity markets continuing to climb higher. So it is definitely a bullish market at the moment. Can the tide turn? Sure. Is it turning right now? I didn't feel like it. It's strong. It's strong until we see, significant breaks below, like, these support levels, maybe below 2,800 or, 2780. It's hard to be bearish equities at the moment. The market is just buying. Everybody's buying every dip, trying to chase. And a lot of this is chasing yield. I mean, and if you're a hedge fund manager and you're underperforming, that's a problem, and you have to put money to work. If you don't put money to work, the risk of redemptions is quite high, because when people, the wealthy look at their their hedge funds and they go, wow, you are underperforming the S&P by a broad margin. Why am I even invested with you? So these asset managers, portfolio managers, hedge funds, they are forced to chase the market higher because they have to chase yield. They have to chase risk higher because they can't afford to underperform and shut their doors. So you've got everybody piling in, and until you got a really clear warning in the market that things are going to turn south, that's the fact of the matter. Volatility is low. People are still looking at positive outcomes between China and the U.S., even though it might be prolonged. People are looking for a positive outcome in Brexit. So and volatility remains abnormally low. But while it remains low, you can't fight the trend.
Since you're on stock indexes, Nick G is asking about the DAX, calling it a daily ascending wedge.
Hey Nick, and it's been a long time. Glad that you're tuned in. I don't know if I'd call it an ascending wedge. I'm zooming out. Let's go over to the 4-hour here. We got this. You can probably look at it, and you might be looking at it like this, something like that, something to this effect, or maybe even probably like that. But let's know that in my belief, a move below 11,400 is a nail in the coffin. in the bearish scheme of things. Now, I'm showing you a 4-hour chart, but let's go out to a daily chart. It's a big head and shoulder pattern that is not completed yet. You guys all see that?
Yeah.
All we're doing is we're testing the neckline. Do I think you should run out and just start shorting the DAX right now? No, but I will tell you it is underperforming U.S. equities. And if U.S. equities look like they're going to turn south, the DAX, okay, I have some dollar max.
Every world bourse is underperforming the U.S.
Yeah, so here's the dollar max trying to break higher out of this triangle. So if the U.S. turns lower, then the DAX might be a decent short. However, I can't be bearish until we get below 11,400. We get below 11,400, then I think the tone for the index changes, and then you have to start thinking, okay, it's time to be bearish. But you know, things have to happen. S&P needs to turn lower. You know, we need to break through that support. I think it is an ascending wedge, which is a bearish reversal pattern. Longer term, we're testing the neckline of a big head and shoulder pattern that never completed or hasn't completed yet. So I think it's going to roll over. But do I have the cojones to take a pop shot at it right now on the short side? Not me. You know, not yet. At least I think you can wait for some confirmation. And, you know, I know some of you are going to say, well, I'll just start nibbling here on the short side, which is fine. I mean, you know your risk. I think your risk is above here, and you know you're wrong, right? Above like 12,000, you know you're wrong. So, whenever you can manage your risk reward, that's all we can do as traders, right? We just manage our risk reward. So
Nick is saying 400 to 680 point range, and you did just show the peso, Joey I, and then I believe the interview will start. I have one of your favorites here today, Blake, Mark Newton.
I like him. He's one of the good guys out there. You know, he is definitely one of the sharper tools in the shed.
There he is. And fundamentals on the Mexican peso, Joey I is asking about.
You know, I'm okay. Again, I'll reiterate. I think Pemex is going to be a big issue for the Mexican government moving forward. I know they are, offering CDSs, and they're being taken up right now, and it's a Band-Aid on a bigger wound. And I think that Pemex is going to be ultimately a drag for the Mexican economy. It represents a huge percentage of the tax bill that goes to the Mexican government. I think Banxico is going to have to enter into probably a longer term easing cycle, or actually I should say that near term easing cycle. And so that, which hasn't come to fruition yet, but I do believe that, we're looking at that going into summer. So I think all things, and then, you take crude. If crude can roll over a little bit, I think that's going to have a negative effect on the peso as well. But which it's more sensitive now to crude oil prices because of Pemex and the red flags that are being waved there. However, I will tell you once again that, if the dollar Mexican peso breaks below 19.20 and definitely below 19, there's no reason to be on the long side of the dollar Mex. I'll play it to the long side now, which I am, and we broke out this little triangle intraday, but I don't mind buying dips at the moment, but fundamentally, I think I would rather be a sell. And then on top of it, you have to throw, AMLO's administration on top of the whole mess, which convolutes the peso outlook even further with his erratic policies. So anyway, there you go. So, Coach, with that being said, I am going to and I want to thank Stelios for being here. Stelios.
Thank you, Stel.
I think he had to leave.
It's always a pleasure. Always a pleasure.
Thanks for being here. Tomorrow, Steve is flying home right now. He might not be in tomorrow. I'm going to urge that he doesn't come in because I think he should rest. But I will be back here tomorrow morning with you all at is it 8 a.m.? I guess it is 8 a.m. Eastern. And I hope you have a great interview with Mark. Like I said, Mark Newton, guys, don't go anywhere. He's one of the, like I said, one of the better technicians out there. So make sure you stick around for him.
Thank you, Blake.
All right. Thanks, guys.
Great job filling in for Steve Volge. And those are big shoes. I think he wears a 13. So anyway, good hunting. Stell, thank you. Mark, I see you. I'm going to make you the presenter now. Got it. What a great time to be talking to you with what's happened here in the markets. In Monday, looked like we were going to have a correction. Friday, I went with the outside weak, buddy, and God, it just exploded to the upside. How are you, my trading warrior brother? Nice scene on the lake. You fishing? So waiting for your audio. Let me check your audio here.
If I had to guess, that's a little northern New York or Rhode Island. If I had to guess, just guess.
I just unmuted you, Mark, so you're on the phone.
Can you guys hear me now?
Yeah, Mark. How are you, buddy?
Hi, very well. Thank you very much, Dale. It's great to be back, and thanks for those kind words, Blake, as well to you. So,
my pleasure. It's great to hear you as always. You're one of the interviews I always stick around for. So, enjoy. Wonderful. Thank you, sir.
Yeah. So, Mark, great time to be talking to you. It's always a good time to talk to you, Mark. I mean, you give you put the jigsaw puzzle together in the market as good as anyone out there on the street. So I'm not even going to lead it. Tell me what's on your radar and what you're paying attention to with what's happened this week.
Yeah, it's been an interesting move the last few months. I think a lot of people use the time from October to December to de-risk, and very few were prepared really for the extent of the rally that followed, and it's been a lot more robust, I think, than many expected in equities anyway. Dollar has shown a few signs of trying to roll over in the last couple months. That's sort of interesting. And, treasuries and stocks have been really moving in tandem of late, which is, a little bit different than what we've seen in the last year. And so,
could we see your screen, buddy? Right now we're looking at.
Sorry, I thought you guys were. Is this okay? Is that a little better?
There you go. Yeah.
Let me try to.
It's fine like that, Mark.
Yeah.
So, the bonds are great. And, I don't know how many times I've, kind of old school that anytime the bonds are about to put on a bull move, you think there might be some de-risking going on. And that just has not played out at all.
No, it hasn't. I mean, it's interesting that the majority of treasuries globally have been a lot stronger. U.S. treasuries have held up, and if anything, there continues to be a flight to want to buy, I think, yield and move into treasuries with the amount of pressure being put on yields overseas, and so there seems to be a decent appetite for treasuries, and it really hasn't affected U.S. markets at all. I mean, the old days used to see signs of when yields started to pull back. Stocks followed, and that just hasn't happened in the last, few months. So it's interesting that, let me, pardon me 1 second. Let me see. I'm on a different screen here. I had some issues with my launch pad, and so I had to, we're just making use of the regular screen today. So, my thinking is that yields still have a move to the downside in the next 2 or 3 weeks that we're likely going to test the levels from early January. So that's really how I see the world, is that right now, technology has helped U.S. equities out quite a bit, but really a lot of the other sectors have not really followed suit. So we haven't seen the same move in financials. We haven't seen the same move in healthcare, and industrials obviously have been led down by stocks like Boeing. So, but largely it's been tech, but that really has not been all that problematic to equities, only because, tech has been so strong, and we've seen that, in many different parts of technology. It hasn't just been, semiconductors or software. And so, interestingly enough, on an equal weighted basis, we see, I use gauges of relative ratios, and technology as a group is actually pushed back through to new all-time high territory above the highs that were made last June. So this is a relative chart of, tech versus the S&P. We started to show divergence in the market when tech peaked out last summer, and as of the latter part of the year that really started to explode. And so this is still very much ongoing, in my view, the technology move.
Yeah, that's interesting, Mark, don't you think? Because a lot of people, after, FANG got taken apart during the decline, most people thought it was over. A lot of, for example, I don't think Amazon has made a new high yet. Google hasn't made a new high yet. So isn't it other things? Apple still way below the high. Isn't it other tech besides FANG that's really leading the parade?
Well, certainly the enterprise software space has been very, very strong. But you've seen some effort of FANG trying to come back in recent days. And I was due to talk about that on CNBC, and then that got swapped for the airline bid on Boeing. And so, I missed out. But I think this is a chart of the MY FANG index, and so it has 10 members. Tesla is included in this, but there is Amazon, Netflix, Google, Facebook, and Apple. Among some of the ones. And, we see this peaked out right when technology did in June, but now it's starting to make a snapback. And while there are some daily DeMark signals, it's been a very strong move. And if anything, many would look at this as being a little triangle in the last month that recently has given way to some decent strength. So, I look at some of the charts of Amazon and Netflix, and, they don't look all that bad in the short run. If anything, we've seen decent bases, but as you're right, they haven't moved back to new high territory. But
someone showed me a weekly chart of Google, and potentially a right shoulder setting up in Google. Otherwise, new highs would be like a third drive. So
the near term has been constructive, but you're right. When you take a longer term look, that could be in the making. We'll see. It certainly seems premature now based on what I see, and so it's not a head and shoulders until it is, and that's a simple lesson for most people. Is that many people get excited when they start to see a stock going sideways and they're seeing this right shoulder. But if you look at DeMark, the last couple of weeks have actually, we had a chance to peak out a few weeks ago, and that failed, and now we're actually extending another count, and this doesn't look complete to me. So I'm actually betting on a further move higher to potentially test these former highs.
Okay.
So I'm not just yet in the camp that tech is going to sell off and really join suit. So there are three things I think that are important for people to realize about this rally, and one is that when you take a look at the breadth of the move that we saw, really it's been stronger than what we've seen in some time from December, January, where advanced decline is now back to new all-time high territory. So, I looked at the deterioration in momentum on a monthly basis, and that's certainly a concern. But when you take a look at, the daily and the weekly and the ability to snap back, I think that certainly is a pretty positive factor, at least in the short run. And I myself have been thinking the market does peak out sometime this year. I'm just skeptical, that the decline just yet has run its course. I think, if anything, the movement in tech is strong. If you start to see some participation in financials and in healthcare and industrials, and that would help things to broaden out a little bit more.
New highs in S&P before the next correction, Mark?
Correction, depending on how you define correction, I think, between now and the end of March, I can still see the potential of more gains, even if you have a near-term stalling out. It looks like the one thing I look at is like NASDAQ versus S&P, and that certainly has shown very little signs of turning down. And so when you see that in place, that's one thing that, on daily charts still looks to me to be quite strong. And that
I know I'm long SQQQ, so I've watched, being on the wrong side of a NASDAQ bearish ETF, how there'd be days where the S&Ps were down 10 handles and NASDAQ would be down 10 points. So, the relative strength's been outstanding. Is that a sign of that being, this rally being more speculative, that NASDAQ is leading the way?
No, I don't know. I don't necessarily know if you can. Look, that's going to fuel the bears in their case to think that yes, that is right. But I think that in general,
How about Russell lagging? Does that mean anything to you?
You know, if anything, what's interesting is I'll pull up a chart here, and you can see what's happened between the Russell and the S&P. I mean, we had a large period in 2014 and 15 where the Russell had lagged pretty substantially, but we've seen, we've seen some outperformance between January, February, and then that's been given back a little in the last couple months. So, you know, I don't know. I think that, it is a concern when you start to see small caps show some real severe deterioration, and we obviously have seen a little bit of that in the last few weeks.
Okay.
The question is whether you can, this is sort of a key level for me where I think it's sort of do or die, where, you might want to try to, right now the trends are negative, but you're at a level of support where things could very well stabilize. So I'm trying to be, bullish and not get too caught up on being negative, just given the trend. And if anything, I want to see more signs of real bullishness before I say, okay, things have gotten way too complacent. People are very optimistic. I just don't see that. Talking with people, when you look at the bullish sentiment polls that have, contracted yet again last week, you see, American Association of Individual Investors might get down to like, a 10. So we don't seem to be at levels certainly that we were last year, where the bulls to bear spread was out near 30, 40. And investors' intelligence has widened out, but I tend to use a combination of these. And when you see both in alignment on the bullish or bearish side, then that's more of an opportunity to get defensive. If you see a lot of bulls right now, I don't see that. I see a lot of skepticism about what's going to happen with China, and people have missed a lot of this rally and are now wondering, they're waiting for a pullback to either get in, or if they're short now, then
they're
technology
trying to break even. They're trying to break even if they're short now.
It's been tough. So to answer your initial question, do I see the market getting back to new all-time highs? I do see the S&P having a shot at doing that. I don't know that the average stock can do that. So I thought, we did see sufficient deterioration into the move down in December, where, we saw, I think, greater than almost half the stocks were down over 20% off their 52-week highs. I mean, that's a pretty serious period of, deterioration, where that's going to be, I think, a problem over the next couple of years. Now, a lot of the longer-term cycles would suggest the market should be peaking out this year, and that the next couple of years are not going to be all that great. But for now, I don't see that as happening right away. I see the time between now and September as still being a time that you want to be long. And really between now and April, I still think the market moves up, and you might have some consolidation and then a final push higher into September. And you have 90-year cycles, you have 45-year cycles, you have a lot of things that are aligned with this year potentially being a pivotal year. However,
not till the fall.
Yeah, I think that, you look at the decennial year stats, you look at just the time following the mid-year term election into a pre-election year. There's a lot of bullish, seasonality and, those other timing-based factors that we all look at. I just don't know that they're in alignment just yet. So,
okay.
I look at a couple things. One is that momentum now is positive on a weekly and a daily basis after having gotten very, very overbought really last year. So, for me, until this rally really starts to show evidence of rolling over, I want to still participate on the upside. The one problematic thing I see technically is that you are faced with a tremendous amount of negative divergence now, momentum-wise, on a monthly basis. And that's not going to go away. And so that is something where it's very similar to what we saw in 2007 and also, near the peak in 2000. That took almost 2 years of negative divergence. But you see a monthly chart, when you start to see divergence when stocks are pushing up, but yet momentum is going lower and lower, I mean, that's a real problem on an intermediate term basis. And so that doesn't mean the next couple months, but that means the next 2 or 3 years. And so I think that has a potential of being lower. I don't know that this year is going to be a down year. I think, if anything, the strength that we've seen the first quarter in stocks likely means that, that this is going to be, that it's going to turn out to be positive, and that really any dips are going to be bought. I want to see some real signs of breadth starting to turn down sharply. The advanced decline pulling back, very few groups participating, and then you line up the longer term momentum with the shorter term breadth deterioration, and you say, okay, we're getting near a time when stocks can truly make a peak. And so I'm eyeing September through October, November. I think this year has a potential of being negative. The dollar, in my view, is slowly but surely starting to peak out. I can't really put a top in just yet. I think that what do
you need to declare a top?
Well, I would want to get down under January lows of I look at the BBDXY only because it only has about 30% against the euro, unlike the Dixie, which is 60 and change. So it looks to be choppy over the last 9-10 months, but I think the lows are. I do see one more chance for a new low in the euro, and pound sterling has been pretty strong. So when you take a look at that just real quick, so you see what I'm seeing. And for those that are not familiar with my madness, I do use a lot of DeMark in my work, and I think right now it's a little premature to think that this snapback in the euro that we saw to the upside in the last week is all that meaningful. I still think that the trend on weekly charts is down. I think you're early to get DeMark exhaustion on a weekly basis. So I would be looking to really sell into euro versus dollar up at 113 to 113.5. Thinking we have a move down to 111 and change over the next 3 to 5 weeks. And for me, that would be a larger time to say, okay, that's when you want to step in and buy the euro, and that's when the dollar starts to make a larger pullback. So, I think we're early. I think, the move in gold has been interesting, and crude. I think commodities.
You keep going to, that's what I was. First you did the dollar, now the gold. So,
gold has been for me has to get up over 1375 to really trigger a true buy, and we just haven't seen that yet. And so, if anything. Let me see if I can shut some of these down. I don't know how to get out of it.
So we rallied almost halfway back to yesterday's high and selling off pretty good. Mm-hmm. Is 1250, 1260 in the cards there with euro going to 111?
I think we can pull back in the short run. I see, the fact we can get from probably 1300 to down near. I see the recent deterioration in the last couple of weeks as being more problematic, and for gold in the short term, I think is a short term top in gold. And so I think you pull back to, 12, if you equal this out and get to 1250, that would be a great chance to take a look at buying into this. So, for me, I want to see both yields and dollar turning down, and that's a time to get long the metals. I think it's been a nice move in the last few months, but I think, I'm still looking at the area that is my sort of line in the sand between bull and bear for gold, and that's 1375. If you get up above 1375, you'll want to get very, very long gold. I think that means that we're going to start a large intermediate term advance. Which, if that happens with the metals, you probably want to own silver because that usually does better when the metals are starting to move in tandem. So
I look at the gold silver ratio chart once in a while, Mark, and recently that gold silver chart, gold's been outperforming. But if you look at a long term chart on gold silver, it looks like it could be putting in a right shoulder of a head and shoulders top here without it being able to go up to new highs. I think we're in the 80s or so for the high of the move.
Yeah, 1 second. Let me see if I can.
Yeah, there you go.
Yeah, so this is gold versus silver. So it still very much favors gold. It's still early, So to get a shoulder, for me.
Again, the shoulder. Yeah, it's got to take out that low.
Yeah, I don't like to get. Yes, I agree that if you're, so. If you take some of these other the Ichimoku out of it, you can make it a little cleaner. Let me see if I can do that real quick.
So you feel the same way about the miners as you do about the bullion?
Yeah, I mean, we had a decent run up, and now we've recently shown a little bit more strength in the last probably week in the miners than you have really in gold, and
that's a change, isn't it?
You know,
over the last month or so.
Yeah, it's always important to. I mean, the miners are certainly a little bit more positive in the short run, so a lot's going to happen versus whether, you know, if you can take out the highs from mid-February. You know, it seems to have been a pretty constructive move back up into this base, and if anything, you look at a weekly chart of how this looks, and it's still pretty constructive, you know, for now. So I think you have to still be long. You know, I don't see much fault with, you know, if the dollar really starts to move up violently for whatever reason, and gold turns down sharply, that might affect this. But I think, you know, for those that are long, you just have to use stops at recent weekly lows, which hits the trend. And, you know, I'm not a day trader. I'm more of a position. So you know, there's no reason not to be.
I'd love to see 19 again if it takes out that trend line. Gold
yeah, well, I think that would be interesting. That would certainly, if that happened over the next few months, you know, and I think seasonally gold sometimes, you know, can be weak between May and July and August before it turns up sharply. And so that might be the time that, you know, the dollar has a little bit of a counter trend jiggle before having a more lengthy decline, you know, potentially. Yeah. But, you know, commodities have, I just look at like the equal weighted, like the CCI index for Thomson Reuters, and, you know, you've been sort of choppy here as well. It hasn't been all that compelling that you want to be long commodities. It's more of a neutral. You know, you really have to be selective in terms of what you own, I think.
So why don't we talk about?
I'm a little more optimistic on
you
crude,
did it again.
Go ahead.
I was just going to ask you about crude. Go ahead.
I think, you know, I'm positive that we can start to turn up into the low 60s. You know, I don't see much that would really prohibit that technically. And if anything, we've seen some decent resilience of late at a time when crude had a chance to really start to roll over into, you know, late February, early March, and that's picked up. So, you know, from a DeMarc perspective, this is likely going to grind up higher into another, you know, 5 to 7 trading days before you see any exhaustion. And on a weekly basis, you know, I can make the case for a move to the 60s. So, you know, I think it's all supply demand, and until you see evidence of demand falling off, you know, the supply, the recent inventory pullback should be supportive for crude to be able to rally seasonally into, you know, April, May, which it normally does anyhow, and then you usually see some evidence of a peak, you know, between, you know, in the summer or in the fall. So,
how about with what you're looking for as a possibility in the dollar? Any emerging markets that are capturing your attention as a weak dollar would be supportive for them? Just like
you know, if you want to run through some, I'm happy if you have some on the top of your mind. I haven't looked at a few in the last couple of weeks. Okay. I mean, we can run through them, but
that's okay. I was just curious with what you saw in the dollar. So bonds are constructive. The market's constructive. The dollar could be in a topping mode. Gold could break one more time for a buying opportunity. Seems like you want to be long the world.
It's crazy, and I don't have a lot that suggests that now's the time to sell. And I look at a combination of momentum, I look at a combination of sentiment, and I look at seasonality, and I look at DeMarc, and none of those things have lined up to say that, you know, we're at an inflection point yet. And so, you know, we'll see if the S&P and the Nasdaq can rally over the next 3 to 5 weeks, then I'd have at least something from a counter trend perspective to say, okay, it's right to take some off the table. But I'm just trying to, you know, I think right now this is one of the strongest times of the year, and there's just not enough to say that it's time to get out of the way. And you know, I think if you miss these times, then sometimes it's difficult when the market turns choppy or turns down to really make it up.
Okay, so. Well, yeah, Mark, another great review of the financial jigsaw puzzle. So I know that people could follow you on Twitter at Mark Newton CMT. You want to show your website and how people can
that'd
get
be
there?
Great. So let me see if I can.
Someone just asked, do you have a view on India?
Yeah,
while you're looking for your website.
Sure. So let's see if I can. If you just want to look at the Sensex, I guess, or there's several different ways, obviously, to look at break India down.
Yeah.
You know, I'm not as enthusiastic on the short run, only because you're getting close to former peaks from last summer, and at least on a daily chart, you're starting to get a little stretched.
Yeah.
In the short run, you know, but I don't see much of an issue overall when you look at these longer term trends. They're still pretty.
Held where it had to.
I mean, that's a decent move in the last 2 or 3 weeks. That means that, you know, for those that were thinking this was going to peak out, the last couple of weeks sort of, you know, really erased that thinking. So I think, you know, let's look real quick if we can on a monthly, and then we'll. I like India on an intermediate term basis. So my concerns are more just that, you know, for those that are not in that, you know, the next couple weeks, you know, you're likely going to be able to buy this a little bit cheaper, but really on any dip, you want to be a buyer. You see these prior DeMark sells that were present back in 14 and, you know, going back and really in 2007, 8, those are nowhere near right now. We're at least 3 to 5 months away from that.
Wow.
So yeah, I am a bull on that. So my website, I'll show that real quick. So that is at newtonadvisor.com. I do provide daily and weekly commentary on equities, treasuries, currencies, commodities. You know, I tend to do a lot on Twitter and on social media. I have a stock Twitch page for those that are looking for long and short ideas that I offer now. I have a room that I'm doing with them, and so I'd encourage you to go there. Or I have, you know, commentary that just talks about, you know, sector rotation and markets and what's ahead for the S&P. So, you know, I've been doing this for the last 30 years, and I'd encourage anybody to follow me initially on Twitter at Mark Newton CMT, and I'll put out some information as to how you can get involved. Send me an email to info@newtonadvisor.com. I'm happy to send you copies of my work.
Thank you so much, my trading warrior brother, for being here today with us and, you know, giving me some clarity. Thank you for edifying faith, Mark.
Thanks, Dale. It's great to join you and good to hear. Glad everybody could tune in today. So thanks for having me and look forward to it in the future. Take care.
All right, buddy. Good hunting. Everyone, that's
bye-bye.
Mark. That's Mark Newton. Alina says thank you. Scott says everyone's very appreciative, Mark. So that's a wrap for us today. See everyone for TGIF. Don't just count your pips, count your blessings, and see everyone tomorrow. Enjoy. Adios.